Did you know that a whopping 70% of stock traders make decisions based on emotions rather than cold, hard data? It's true. This surprising statistic reveals a fundamental truth about the stock market. It's not always about logic. Fear and greed often hold more sway than spreadsheets and algorithms. We like to think we're rational beings, especially when it comes to money. But the stock market has a way of tapping into our primal instincts. When the market is soaring, we feel invincible, eager to jump on the bandwagon. Conversely, a sudden drop can trigger panic, sending us scrambling for the exits. Understanding this emotional undercurrent is crucial for navigating the stock market effectively. It's not enough to simply analyze charts and crunch numbers. We need to acknowledge the powerful role of human psychology in shaping market trends. The stock market is like a living, breathing entity, driven by the collective emotions of millions of investors. By recognizing this, we can gain a valuable edge in our investment journey. Stock market trends. Those lines on a chart zigging and zagging can seem like a cryptic language. We're drawn to them, hoping they hold the secret to quick riches. But the truth is, stock charts are just a starting point. Think of them as a map. A map shows you the roads and landmarks, but it doesn't tell you about the traffic jams, the scenic detours, or the local culture. Similarly, charts show you price movements, but they don't reveal the full story behind those movements. To truly unlock the secrets of stock market trends, we need to dig deeper. We need to understand the forces that drive those trends, the factors that influence investor behavior, and the events that shape market sentiment. It's about looking beyond the technical indicators and delving into the realm of market psychology, economic trends, and global events. It's about connecting the dots between the charts and the real world. Many new investors fall into the trap of believing that charts hold all the answers. They pore over candlestick patterns, moving averages, and other technical indicators, hoping to find the magic formula for predicting market movements. But the market is a complex beast, influenced by countless variables. Charts can only capture a fraction of this complexity. They can show us what happened in the past, but they can't predict the future with certainty. Relying solely on charts is like trying to judge a book by its cover. You might get a glimpse of the genre or the writing style, but you'll miss out on the richness of the story, the depth of the characters, and the power of the narrative. Investing solely based on chart patterns can lead to costly mistakes. The market is full of false signals and head fakes, designed to shake out the weak hands. To avoid these pitfalls, we need to broaden our perspective and look beyond the surface. The whisper of sentiment, the roar of events. Imagine a vast flock of birds, all soaring in unison. Each bird represents an individual investor, moving together in harmony. Suddenly, a loud noise startles them, and the entire flock changes direction in an instant. This sudden shift is akin to how market sentiment can change rapidly. This is how market sentiment works. It's a collective response, a shared reaction to external stimuli. Market sentiment refers to the overall attitude of investors towards a particular stock, sector, or the market as a whole. It's a barometer of the market's emotional state. It's the collective mood, the prevailing emotion that drives buying and selling decisions. This mood can be influenced by a variety of factors. News events, economic data, and even social media trends can all influence market sentiment. A single tweet or news headline can sway the market. A positive earnings report can spark a surge of optimism, leading to a buying frenzy and driving stock prices up, while a geopolitical crisis can trigger a wave of fear, causing a sell-off and plummeting stock prices. For example, remember the oil price crash of 2020? It was a time of unprecedented uncertainty. The pandemic had just begun, demand for oil plummeted, and the world was grappling with a new reality, and prices went into freefall. The market was reacting not just to supply and demand, but to the fear and uncertainty of the times. This wasn't just about supply and demand curves, it was a reflection of the collective anxiety and fear. It was about the fear gripping the market, the uncertainty about the future. Investors were unsure of what lay ahead, the uncertainty about the future. This uncertainty can paralyze decision-making and lead to drastic market movements. Understanding market sentiment is crucial for interpreting stock market trends. It provides insight into the collective psyche of investors. It helps us gauge the collective mood of investors and anticipate potential shifts in market direction. By understanding sentiment, we can better predict market movements and anticipate potential shifts in market direction. It's about reading the tea leaves, listening to the whispers, and preparing for the inevitable changes. It's about reading the tea leaves, listening to the whispers, and bracing for the roars that can shake the market to its core. By staying attuned to sentiment, we can navigate the market's ebbs and flows more effectively, and bracing for the roars that can shake the market to its core. In the end, understanding market sentiment is not just about numbers and charts, it's about understanding human behavior and emotions. When context conquered charts the rise and fall of XYZ Corp. Let's talk about XYZ Corp, a darling of the tech industry in the late 1990s. This company was the epitome of the dot-com era, capturing the imagination of investors and tech enthusiasts alike. Their stock chart was a thing of beauty, a steep upward climb that had investors drooling. It seemed like the company could do no wrong, with its stock price soaring to unprecedented heights. Everyone wanted a piece of the action. The excitement was palpable, and the media couldn't get enough of XYZ Corp's meteoric rise. But beneath the surface, a different story was unfolding. The company's rapid growth masked underlying issues that would soon come to light. XYZ Corp was built on hype, not on solid fundamentals. The frenzy around the company was driven more by speculation than by a sustainable business model. Their products were innovative, yes, but their business model was unsustainable. They were pushing boundaries in technology but failing to establish a solid financial foundation. They were burning through cash faster than they could make it. The company's expenses were skyrocketing and their revenue couldn't keep up. Those who focused solely on the charts missed these crucial warning signs. They were enamored with the stock's performance, ignoring the red flags in the company's financial health. They saw only the rising stock price, blinded by the allure of quick profits. The promise of rapid returns overshadowed the need for due diligence. They failed to grasp the broader context, the shaky foundations upon which XYZ Corp was built. The company's success was a house of cards ready to collapse at any moment. When the dot-com bubble burst, XYZ Corp came crashing down, taking countless investors down with it. The collapse was swift and brutal, leaving many in financial ruin. Their stock chart, once a symbol of success, became a stark reminder of the dangers of ignoring the bigger picture. The dramatic fall from grace was a wake-up call for the entire industry. This case study highlights a crucial lesson: context is king. It's not enough to look at stock prices and growth charts. Understanding the full picture is essential. Understanding the underlying factors driving a company's performance, the industry dynamics, and the overall economic climate is essential for making informed investment decisions. Investors must dig deeper, beyond the surface-level metrics. Charts can be deceiving. Context provides clarity. By considering the broader context, investors can avoid the pitfalls of hype and make more prudent decisions. The bigger picture, a symphony of signals. The stock market is like a grand symphony orchestra, where every element plays a crucial role in creating a harmonious performance. There are multiple instruments playing at once, each contributing to the overall melody, just as various market factors contribute to the stock market's movements. We have the strings of economic data, which provide the foundational rhythm and tone. The brass of corporate earnings, adding bold and powerful notes to the composition. The woodwinds of market sentiment, which bring in the subtle nuances and shifts in mood, and the percussion of geopolitical events, providing the dramatic and often unpredictable beats. Trying to understand stock market trends by focusing on just one instrument is like listening to a symphony with only one ear. You might catch a few notes, but you'll miss the richness and complexity of the music. You might hear a few notes, but you'll miss the richness and complexity of the music. The true beauty lies in the interplay of all the instruments. To truly appreciate the symphony, you need to listen to all the instruments in harmony, understanding how they complement and enhance each other. Similarly, to decipher stock market trends, we need to consider all the factors at play: economic indicators, industry trends, company fundamentals, market sentiment, and global events. Each of these elements plays a part in the grand performance of the market. It's about connecting the dots, understanding how each piece of the puzzle fits into the bigger picture. By seeing how these elements interact, we can gain a clearer understanding of market movements. It's about recognizing that stock market trends are not random occurrences. They are the result of a complex interplay of forces, each influencing the other in a delicate balance. They are the result of a complex interplay of forces. By appreciating this symphony of signals, we can better navigate the market's ebbs and flows, making more informed decisions. Join the conversation, deciphering the market's language. We've only scratched the surface of understanding stock market trends and their implications. This is a journey of continuous learning and growth, of refining our analytical skills and techniques, and of developing a keen eye for both the obvious and the subtle signals the market sends our way. So I encourage you to keep exploring, keep asking questions, and keep challenging conventional wisdom and norms. Don't be afraid to delve into the intricacies of economic reports, to dissect company earnings calls in detail, and to engage in thoughtful discussions about market trends. Remember, the stock market is not a get-rich-quick scheme. It's a complex ecosystem that rewards those who approach it with patience, diligence, and a thirst for knowledge and understanding. Now I turn the conversation over to you. What are your thoughts on analyzing stock market trends? What tools or strategies do you find helpful in your analysis? Share your insights and let's continue this journey of discovery together.